guys, so now let's move on to the toughest part of chapter 3, which is the materiality discussion. Okay, so first off, we just have some definitions of materiality. These are consistent with what we talked about in chapter 18 when we discussed materiality briefly. So information is basically material if omitting it or misstating it will influence decisions made by reasonable users of the financial statements. Okay, so this kind of begs the question, what is a reasonable user? And there is actually a formal definition of reasonable user, believe it or not. So it's somebody assumed to have a reasonable knowledge of business, economics, accounting. So basically, they're assumed not to be people with no educational background in this who, fundamentally don't understand how financial statements work, how financial statements are audited. They don't understand that they're being audited and the auditors are providing reasonable assurance, not absolute assurance. They understand there are lots of estimates in the financial statements. And so there's a certain amount of uncertainty that comes with that. We also remember, hopefully, from our chapter 18 discussion that both quantitative and qualitative materiality are important. Quantitative materiality refers to the materiality threshold calculated by the auditor. And this, again, this is almost more of a bright line materiality, right? Because we're calculating a threshold and saying, hey, materiality is 3% of pre-tax net income. And if a number is incorrect by more than that, then we'd say it's materially misstated. If it's misstated by less than that, it's not materially misstated, right? We'd say that error is immaterial and we would move on. Qualitative materiality is more of the principle of materiality, and it's something that is really going to affect a reasonable user's decisions, but we don't really care if it's over that numerical threshold, right? It can be under the numerical threshold and affect their decision, then we'd say it was material. So you'll notice as we're going through this topic today that materiality is not absolute. It tends to not be a black and white issue. And materiality can change throughout the audit. So we can have a slightly larger threshold at the beginning, maybe because it's based on estimated pre-tax net income. And then at the end of the audit, maybe they made less that year. So we need to scale back on materiality, or maybe they wound up engaging in some high risk activities that year, right? Because risk goes into this decision too. And so maybe we want to, again, scale back on materiality and be a bit more conservative. So materiality is fluid and requires lots of professional judgment. Now we're going to quickly talk through the steps in applying materiality on an audit. So step 1 is to determine overall materiality, also known as planning materiality. So again, overall materiality represents the amount by which the auditor feels those financial statements could be misstated before they start impacting the decision of reasonable users. So we're trying to find this threshold here where above the line, it impacts the reasonable users. Below the line, it doesn't impact the reasonable users. So we want to figure out where is that threshold. Another thing to consider, and we'll talk more about this as we go, is the lower you set that threshold, the more costly the audit is, because it's going to mean you're pulling in a lot more accounts as material, you're pulling in a lot more transactions as material if you set this threshold really low. However, the higher you set that threshold, the more risky it is to you as an auditor, because I'm calling everything underneath here immaterial, and maybe it will affect somebody's judgment. So I generally want to be conservative here when I'm determining the threshold, but I don't want to be too conservative because then it starts getting costly, but I don't want to be too aggressive because then that could expose me to risk in other ways. So in terms of our quantitative basis for setting materiality, these are some benchmarks and ranges that we would use. So pre-tax net income is the most common basis for materiality. And we said the typical range is 3 to 5%. In theory, you could go as high as 10% for your materiality threshold. And then there are also these other bases for materiality, which are used sometimes. And what it really determines is One, what type of business is it? Like, is it a for-profit, a non-for-profit, et cetera? Is it a mutual fund? And the other big consideration is how risky is this? That's what's going to determine the low end of the range or the high end of the range. We have this little question down here. What if pre-tax net income is negative for a year? Okay, so pre-tax net income, we said, is our typical default materiality threshold for a for-profit business, right? Because for for-profit businesses, pre-tax net income is a major metric that they're judged on. So if pre-tax net income is break even, near zero, or negative for a year, and I take 3% of that, then I'm basically taking 3% of zero, or a negative number. So I'm saying zero is my materiality threshold. So basically any number is going to be above that. Everything becomes material. That's not going to work, right? I'll be auditing this client for years if everything's material, because in that case, you'd basically be providing absolute assurance, right? If everything over zero is material. So for clients like that with break-even pre-tax net income or negative pre-tax net income, obviously that's not going to work as a materiality threshold because you won't get a number that makes sense. So for those clients, you'd often switch to an alternative benchmark, such as total assets is a very common one. This is also true for other types of businesses. So for example, mutual funds or benefit plans. Often for those, pre-tax net income is not really a relevant benchmark, but total assets is, so it's more common to see in those settings. And I'd recommend you, of course, I always recommend you read the textbook, but read through this discussion in the textbook because it talks about different examples and different benchmarks you would use. And I can tell you personally what I saw in practice was limited to pre-tax net income and total assets. In theory, you can use these other thresholds, but I personally did not see it. I basically saw pre-tax net income always, except for benefit plans where we use total assets, and for a year where my for-profit client was at a break even, and then we use total assets for them too. So these others are things you can use, but they're less common. And we also talked about not just the benchmark, which the benchmark is the pre-tax net income, assets, et cetera, but we also have the range to consider. So that's when we go to the spectrum, and at the low end of the range, so like 3% of pre-tax, that means you think that client is high risk and you want to do more work, right? If I'm setting the threshold for what's material down here, that means I know I'm going to do a lot more work because everything up here is going to be material. And so that's what I would want to do if my client was very risky to me. For the high materiality threshold, I'm setting it up here. That means I'm pretty confident with the client. And I think they're relatively low risk because I'm only going to be looking at this portion of transactions, and all this is going to be immaterial. Now we do a little testing over the immaterial stuff as well, but nowhere near as much as we scrutinize the transactions and the accounts that we say are material. So these are some of the risk factors to consider when you're determining if you're at the low end of the range or the high end of the range. So we would think about if they'd had material misstatements in prior years. Obviously, if we found a lot of misstatements last year, I'm not putting them at low risk this year. Similarly, high risk of fraud, I want to set that threshold low. If they have going concern issues, I want to set that threshold low. So the stuff is pretty much common sense in terms of the risk, but just keep in mind, really most of the time, you're going to be somewhere in the middle of your threshold. If it's a public company, you tend to set the threshold lower too, because public companies expose auditors to more litigation risk and reputational damage if something goes wrong. The high end of the threshold would generally be reserved for really not just low risk clients, but also private clients that aren't going to have that same kind of like reputational exposure associated with them. And they would need very convincing documentation to go with the high end of the range. So one time on one of my clients, again, a private client was relatively low risk, we went with the high end of the range, and the senior manager wrote like a 30-page memo supporting why we were able to go with the high end of the range. So lots of documentation, lots of argument there about, or not argument, but justification there about why we felt it was valid to go with the high end of the range. So it's really not commonly seen. Now we're going to talk about step 2, which is determining tolerable misstatement. So you've set your overall, stepping back, we've set our overall planning materiality up here. This, that is 3 to 5% net income, that is really considered to be kind of your safety net. And so typically when we're going through and we're determining which accounts are material and which transactions are material, we don't want to use a threshold as large as our overall materiality. What we want to do is be a bit more conservative. And so typically what auditors do once they've calculated their overall materiality is they cut that number in half. Now this says 50 to 75% again, so we either cut it in half, 50%, or we just reduce it a bit, use 75% of that overall materiality number. And this new number that is 50 to 75% of overall materiality is what is called tolerable misstatement or tolerable error. And again, the 50 to 75 decision is based on risk. So if we think the client is more risky, we're going to go with 50%. If we think the client is less risky, we're going to go with 75%. Now, the first thing that we use tolerable misstatement for is to identify what we call significant accounts. The purpose of this is we want to audit all balances over TM or tolerable misstatement. So before we continue, I want to share this workbook with you. You are going to find this along with the chapter 3 slides attached to the series of lectures. So this provides us with a helpful example of the different types of materiality that we can kind of walk through together. So for this company, Berry Plastics Group, Inc., that's who we're auditing. Input into here is various numbers representing their income, sales, GM, equity, assets, and here you can kind of calculate the lower upper end of the range. So if you want to do this 3%, can. And this gives us the sort of various materiality ranges using the different benchmarks. So like we said, once we have overall materiality, we're going to calculate TM or tolerable misstatement. This could be anywhere, typically 50 to 75%. It could theoretically be as low as 25%. But let's say we do 50%, which is often the default tolerable misstatement. So your tolerable misstatement is now 1,275,000. And the first thing we're going to do with this number is to use it to identify significant accounts. And we want to audit all balances over TM. So let's talk about what that means in the context of our new example. If I want to audit all accounts over 1.275 million, what I need to do is look over here now at the company's balance sheet, and this is how I'm going to determine my significant accounts. So every account, and these are listed in millions. So every account over my 1.275, that is going to be a significant account. So you see the vast majority of these are well over 1.275, right? Cash and cash equivalents, AR, inventory. Now, occasionally you'll get an account like prepaids and other long-term assets tend to be common ones where that account is under your TM threshold. So let's say this is 500K, then that account will not be considered a significant account and you won't have to perform extensive audit procedures over it. Now, what we will do is we will look at any significant changes from prior year and we'll look at it kind of high level analytically. If we see nothing of concern there, we'll move on and get that account done very quickly. If we saw a big drop like this going from 42 million down to 1 million, we would be a little suspicious of that. One, it's just a big change. Two, it's the account number seems to have changed to come under our materiality. So we might think, oh, maybe they don't want us to look there. So we would, in that case, go through and validate all the changes that occurred during the year, right? Because even if the ending balance isn't material, The change certainly is material, so we would still want to take a look at that and understand all of its components. Now, if it was 600K last year and 500K this year, frankly, we would put that into a schedule. We'd say, hey, this is the change. The change is immaterial. The account is immaterial. We're not concerned with it. We don't feel the need to perform further audit procedures over it. Now, the next thing we use TM for is to allocate TM to establish a scope for audit procedures within individual account balances. All right, so the allocation of TM is actually what's going on this slide, and we have it in the workbook too, which I'll show you in a minute. But basically the idea is when I'm auditing cash, the threshold by which I decided to audit cash was TM. But when I'm looking at all the individual accounts inside cash, making it up, the threshold for those is going to be 75% TM or whatever I decide. So again, to show you what I mean, I'm going to come over to my spreadsheet here. So let's say I've assigned 50% of TM, that is my allocation of TM to AR. What does that mean in practical terms? That means when I come over here and I drill down on the accounts receivable balance of 449 million and look at all these individual balances making it up, then that means that I'm going to test every one of these individual accounts making it up that is greater than 50% TM, because that was my allocation to AR. So this is just pulling from that first tab in the spreadsheet where I said materiality was 1275000, and it is multiplying that number by 50% to get the TM allocation for AR. So when I'm going down through these accounts, I'm comparing them in size to the 637,500. And if they're above that, then they're above the threshold and I have to test them. If they're below that, then they're below the threshold, like miscellaneous AR is only 450K. Now, because that is below 637K, I should not have to test it because it's less than the threshold. Again, if this was a really big number last year and now suddenly it's small, we would want to test and understand the change because the change is material. But if this miscellaneous AR balance is constantly pretty small, then it's not something we're going to be terribly worried about. So when I go and perform my procedures, I'm going to be focusing on these two accounts, this account, and this account, and I'm not going to be spending time on this guy because it's immaterial to me. And the thinking there is because this account itself is so small, it's highly unlikely that an error in this account could exceed TM, much less exceed overall materiality, given how small the account is to begin with. Okay, so coming back to this slide, hopefully you understand now that these allocation of TM thresholds just represent the testing thresholds when I'm within the individual accounts doing tests. So again, smaller thresholds are going to mean I have to do more work, whereas larger thresholds mean less work because smaller thresholds are going to pick up more balances within these accounts and say more of these are material. If my threshold was lower, I would have also picked up that 450K miscellaneous AR balance, and then I would have to test that too. But since I have that materiality threshold in place, I'm able to skip over testing that balance. Risk surrounding the account leads to the allocation decision. So if I believe an account is relatively low risk, I'm going to be comfortable with a higher allocation percentage. If I think an account is high risk, I'm going to go with one of these lower percentages. And just to be clear, these percentages for the allocations, they will change for each audit in each year. These allocations are not numbers that you need to memorize because they're always the same. Right? Again, it's going to be based on judgment and risk. So you'll typically see asset accounts like cash and AR that are pretty easy to audit and generally thought to have relatively low risk of misstatement. you'll see those with big allocations, and accrued liabilities you'll tend to see with these smaller allocations. Another thing you'll notice is often asset accounts. The risk there is that they're overstated, so we tend to make our thresholds or TM allocations larger, whereas for accounts like these, they're liability accounts, the risk tends to be more that they would be understated. So if the worry is they're too small, then it makes sense to set our allocation thresholds a little bit lower for these accounts.